There are a few different ways to build a new house. Sometimes you might find a builder that is going to completely finish the build before you pay them. You get a loan once the completion stage is reached. Sometimes you might be buying an established property, knocking it down and building a new house on top. But what we're going to focus on is the most common type of construction, where you buy a brand new block of land or a titled block of land. You sign up to a builder and they build the house, and you pay the builder in stages. They pour the slab, they build the frame, you pay them as they complete the work. That's what we typically see with our clients, and it's the most common form of construction. So that's why we're going to be focusing on that today. When you buy a block of land, typically the developer needs some time to finish the work. So you might say, okay, I want to buy this little piece of land amongst this big estate. And the developer says, that's fantastic, I'll sign you up. And you need to give us 3 months, 6 months, 12 months to finish that little stage before your little block of land is actually ready. So it gives you some time to save towards the purchase and save towards the build. But what I want to focus on is actually the cost of the purchase itself. So I've got an example set up here where we're purchasing an established property for $800,000. And I want to show you the difference in cost between established and building, because it's much easier to get in when you're building, when you have a lower deposit. So if we purchased for $800,000 and we're assuming we're going to live in the house in Victoria, we have $43,000 worth of stamp duty. Now, we don't need a 20% deposit for a build, but assuming that we're trying to avoid mortgage insurance and it's just a home, it's not our first home, you need $208,000 to avoid mortgage insurance and get into the property. If it was your first home and we're applying for first home owner concessions on stamp duty, we're applying for a government scheme where you can only provide you only have to provide a 5% deposit plus the costs. That is actually going to drastically reduce. You can see if we only need the 5% deposit plus costs, we're down from $208,000 to $88,000. So huge benefit for first home buyers to get into the market. You would have noticed that stamp duty didn't actually change, and that's because there's no concession for stamp duty when first home buyers are purchasing above $750. So we're above $750 here. But you can see $88,000 to $208,000 as a required deposit for this $800,000 purchase price. Now, if we change this to construction and we just split it in the middle, $400,000 for the land, $400,000 for the build, you can see that stamp duty is drastically reduced from $43,000 down to $16,500 for an owner occupier. And for a first home buyer, because this value is under $600,000, the land value under $600,000, stamp duty is completely waived. So huge benefit when building, and we're trying to reduce the deposit. So again, if we're looking at a 20% deposit plus costs for an owner occupier, we've gone from $208,000 to $181,000. So, $27,000 worth of savings to build the same value house that you were going to buy before. We'll talk about some other things in a minute, but huge reduction in the deposit required. First home buyers is going to be even further. So we're reducing stamp duty, waiving stamp duty. We're eligible for a first home concession and a 5% deposit. We've gone from $88,000 down to $45,000. But it gets better because when you build a first home, you're also eligible for a $10,000 grant. And that reduces the required deposit to $35,000. So you can get into a purchase $800,000 with $35,000 cash. There's a little asterisk here because this 5% deposit says that you actually need 5% savings, and 5% of $800,000 is $40,000. So whilst we can get away with $35,000, we do actually need to contribute $40,000 to make everybody happy and get in the door. But $40,000 is a lot better than $88,000. So as you can see, buying and building, there's a huge discrepancy between the deposit required, especially when we take into consideration the concessions on stamp duty, the government schemes, and a grant for first home buyers. One of the biggest considerations for clients when they're building a house is what the cost will be while they're waiting. Now, you don't have the mortgage until you actually purchase the land, and we'll talk about the timing in a minute, but while you're waiting for the build to happen, you do have mortgage repayments. And so those repayments will be tacked on to your regular living costs. And if you're renting, you've now got rent and mortgage repayments to make. I also mentioned that the deposit when you're building is much lower than when you're buying an established property. But what you need to think about when you're building is that a builder doesn't always account for all of the things you need on a property. They're signing you up to build the house, and they might not include carpets, blinds, driveway, landscaping, fencing. And so yes, you're saving on the deposit to get into the property, but when you account for all of those little extras that you need to pay for, when you account for interest on the mortgage while you're waiting for the build, when you're accounting for rent when you're waiting for the build, that deposit that you've saved will get quickly eaten up amongst those other items. So huge thing to consider there. On a side note, when I mentioned the 5% deposit requirements for a first home buyer, technically we can get away with $35,000, but the government scheme requires you have a 5% savings deposit, so $40,000. If you're chipping in $40,000 in total, what if the land developer wanted a 10% deposit instead of a 5%? It means that you would need extra savings to secure that block. And then when time comes to actually get the mortgage, the bank says, well, you didn't need 10%, you only need 5%, so I'm going to give you that 5% back. So there's some timing and some logistical issues that we need to factor in here as well. Do you need more savings just to secure the block or to secure the build, which you can get back later? And if you need that, do you have that? Maybe it's the other way around. Maybe you've got 5% required, but to actually settle the loan, you need 5% plus some extra costs. You actually need 7% or 8%. So there's a few things that we talk about logistically when it comes to building as well. Now, when we're building, we've kind of got a timeline of sign land contract and pay deposit. And we've got 6 months, 12 months until that is ready to title. So in that period of time, we're finding a builder, we're finalizing the plans and the specifications for the house that we want to build. And then when we get ready for land settlement, 4 to 6 weeks out from the land settling, that's when we go and get our loan approval. So we want to try and predict what financial position we'll be in. Hopefully rates haven't changed in that time. Everything lines up so that when we go back for the land approval, we can pay for these contracts that we've already signed up for. Once land settles, the builder will apply for the permits. They'll start the construction, pour the slab, build the frame, so on and so forth. But that settlement period is really important because we need to make sure that we've got our deposit ready, our contribution ready. So in this example of an owner-occupier building for $800,000, we're chipping in $181,000. We've paid a little bit towards the land, we've paid a little bit towards the builder, we've got a lot left to go towards settlement. Sometimes that contribution will go towards land settlement completely and the bank will hold back all the funds for construction. Sometimes the bank will say, pay what you need towards the land and we'll lend 80% of the land. And if you've still got some money left over, you can pay the builder as they invoice you for stages. But the timing is really important because we need to make sure that we've got the cash ready and we need to make sure that the cash flow is going to work when land settles until you actually get to move into the house. And that's what we're going to show next. So in this example, we've got the loan of 80% of the land value, and then the rest of it will be used as the build is completed. So we're assuming 30-year term, 6.2%. During a build, repayments are interest only. So we've got $1,653 when the land settles. But as the bank starts to contribute towards the build, those repayments start to increase. And when we get all the way to completion, we've got a principal and interest repayment of $3,920. Now, if the completion stage has gone through and you've still got a month or 2 months left of your lease, then you've got to factor that in. So the repayments can be a huge detriment if you're renting. And we want to make sure we've got the cash flow to support everything so that when you move into your house, you're not moving in, savingsless. You've got some cash ready for all those other items that you needed, like landscaping, new furniture, even just a savings buffer. I hope this has explained what's involved with construction loans. Now, there's obviously a lot more involved. We can get a lot more detailed, but this is a bit of an overview of how it works. So be sure to give me a call in the office, book an appointment for a time that suits you. I'll be more than happy to discuss how we can get you into your new home, or at least just consider how construction is going to work in comparison to buying an established property.